stop putting the bulk of your assets into the S&P 500. Not to say that it's a bad investment, not to say that the S&P 500 isn't going to do well over the long term, but I think there's a lot of risk baked into the S&P that a lot of people just don't recognize, and here's why. So allow me to direct you to the Nikkei 225, which is effectively Japanese stock market. You'll notice from the period of about 1989, 1990, all the way to effectively where we are currently, right around 23, 24, just a couple years back, there has been effectively no growth. We've seen this large decline in the asset price and then relative stagnation, only to see recent increase in valuations in the last, call it, decade, and only reaching back to where we originally were in the last couple of years. So effectively 30 years of stagnation. Now, of course, the Japanese stock market situation is an extremely complex situation. That said, it can be really boiled down to two major factors. Number one, credit was really cheap. Interest rates were extremely low during that time. And number two, banks would lend money to just about anyone. Now, what's happening in the United States is a little bit different than that, but we are seeing record low interest rates right now. We have an extremely low interest rate environment, and we're printing a lot of money. The amount of money in our economy right now is insane. The M2 money supply has increased drastically post-COVID, and I think the combination of low interest rates and a huge amount of money supply in our system has resulted in not necessarily what I would call an asset bubble, but potential overvaluation that could cause a non-diversified portfolio to see major stagnation over the next, call it, decade. And so the next chart I want to draw your attention to is the M2 money supply, which is effectively the total amount of liquid capital in our economy. You'll notice from the period of 2020, we had about, call it, $16 trillion in total M2 money supply. That then jumped to about $22 trillion, to call it $21.5 trillion of total M2 money supply in just a 2-year period. The problem is most of that money ends up in assets. It ends up purchasing assets, be it real estate, stocks, mutual funds, whatever. The point is it ends up inflating the value of assets. The more money that goes into an asset, the higher the value of that asset is. And that's what causes a bubble. Again, I'm not saying that we're in a bubble. What I am saying, though, is that asset prices are inflated as a result of having more money in our system and extremely cheap interest rates to access that capital with really no downside. And so that brings us back to our economy, the S&P 500. And you'll notice that we've actually had periods, granted not as long as the Japanese decline in stock market valuation, but we've had periods like a 10-year period from 2000s to 2010, where effectively, had you put in capital during this point, you would have really made no money up until about 10 years later. And again, we saw this in the late 60s through the early 80s. Again, had you invested around this period, call it 1965 to 1970, you really wouldn't have made any money until all the way into the early 80s before it actually started to see real asset appreciation again. Now, again, I'm not necessarily saying that we're seeing this exact situation unfolding today, but what I am saying is that history does tend to repeat itself, and you might be better off with some of or even a large portion of your assets outside of the S&P 500. And finally, I think one really important thing to understand when investing in the S&P 500 is that you are not actually spreading out your investment over 500 companies in the US stock market evenly. Rather, you have the bulk of your investment in the top, call it, 7 companies in the United States, that being NVIDIA, Apple, Microsoft, Amazon, Alphabet, and Meta. These companies collectively make up about 30% of the S&P 500. Even though they're only 7 of the 500 companies, their weight, the percentage of the S&P 500's value in total, is about 30% of the S&P 500 index. So really, you're investing in these top 7 companies. Not to say that these are bad companies, but again, I think a lot of investors don't realize that they're actually participating primarily in a handful of few very large companies, as opposed to really spreading their eggs across 500 different companies evenly. So here's the thing. I think the S&P 500 is going to do just fine over the long term. I'm bullish on the S&P over the next 30, 40 years. I'm bullish on America over the next 30, 40 years. The top 7 companies that make up the S&P 500, I think, are great companies. That said, I think it's important to have some diversification in your portfolio, and allocating some of your resources towards non-market traded assets, or at least non-S&P focused assets, I think could be extremely beneficial if we run into, a 5-year or 10-year period where there's relative stagnation or very little growth in the S&P 500. So it might be time to take a look at your portfolio, consider that there might be overallocation in certain asset classes, specifically the S&P 500, and consider reallocating some of those resources into other potentially non-market traded assets, or at least assets that are not solely focused on, the top 10 companies in the S&P 500.